Welcome to Wall Street Bets DD, where I read some of the most popular DD of the week in my action movie narrator voice. This is not financial advice. This is not even my post. This is just for entertainment purposes only. Since I know you apes can't read, I decided to read for you. So sit back, relax, and enjoy the shit show. Oh, and don't forget to like, comment, and subscribe. Or else I'm telling your wife's boyfriend to cut you out of the will. Post by Chemical. My lucky CLOV, a case study in the meme market's epileptic squeezers and why the market is ready for another. Alright folks, so you've heard CLOV looks good for an epic run. And oh boy does it. I have a full write-up broken into multiple parts and I'm spending quite a bit of time on this. I hope you find it useful. If there is any organizational changes I can make to allow reading it easier, please let me know. If you find any piece of information wrong, please point it out but also explain. I've spent a lot of time learning about the market since the meme stocks started what they've been doing. It's fascinating. And I've learned so much, lost money, made money, but am overall better for the education. I don't know everything and I am open to counter arguments and more details where I may have missed some. Thanks. The brief summary of data, CLOV option open interest on August 20th is absolutely enormous. For perspective, this Friday has a typical number of contracts for the stock. We see 77,006 calls and 31,986 puts expiring August 13th. Friday, August 20th, however, we have jaw-dropping 306,424 calls and 72,752 puts. This puts us right on track for a gamma squeeze. Details further down. Earnings report showed a surprise beat on revenue over 100%. Critical for growth stocks. We are at a local minimum value on the stock. So with a great earnings report, investors are eager to buy the stock. We saw this on August 12th after earnings with the insane amount of volume, 147.4 million versus the average of 29.22 million, fighting for the price around $9 a share. These factors, plus 25% short interest, mean that CLOV is ripe for a major mind-melting squeeze beginning the week of the futures contract rollover dates beginning on the futures first notice day, August 26. The futures contracts are a key piece of this meme stock puzzle that many have been trying to solve. This will likely peak before September 9th due to futures rollover dates, unless we see insane price action reaching margin call levels, which, considering the DTCC's updated uncleared margin rules going into effect on Sept 1st, is expected to cause a spike in margin calls. I'm cutting this TLDR out because it is clearly financial advice, which is not what I am trying to do here. But basically, come September, the poster is saying CLOV will go to the moon, hashtag rocket emojis. However, the post will be in the description for those who are curious. Anyway, let's get back to the post. Table of contents. Number 1. What the hell is a gamma squeeze? Number 2. How will we recognize a gamma squeeze? How long can it take to play out? Number 3. FTDs. Number 4. Futures contracts rollover dates. Triple witching rollover edition, and we're in a Ford Bronco. What the hell is a gamma squeeze and how do you predict one is going to happen? A gamma squeeze is a product of the derivatives calls and puts market. Usually this is a rare event, but with growing accessibility to the markets by retail investors, it is becoming more common. Tinfoil hat. This will not last forever. They will nerf this feature at some point. What causes the gamma squeeze? Unusually high call option open interest plus rise in share price plus market maker delta hedging. Delta hedging is when market makers buy and sell shares in a stock to remain delta neutral. See, a hedge fund is intended to provide liquidity and help you buy and sell shares, but they don't want to be on the bad side of a trade, so they remain delta neutral. Delta is a value that affects the option price on calls and puts. It is directly related to the rate of change in stock price. So if you have a call option with a delta of 0.1, a market maker needs to buy 10 shares to hedge. A delta of 0.5 would be 50 shares, and the max delta is 1.0 or 100 shares. The more call options open, the more market makers have to do this. As you might be figuring out, if the market makers have to buy shares to delta hedge, and there are an immense amount of call options open, then the buying action from market makers to delta hedge can and will drive up the price. As retail investors continue to buy shares and the price climbs, market makers must also buy shares to delta hedge. This causes a snowballing effect called the gamma squeeze. We saw this happen with so many stocks now. AMC in June, CLOV in June. Gamma is the value that measures the rate of change in delta, so the faster the price changes, the higher the delta, and gamma runs higher as delta changes faster, hence why it is termed a gamma squeeze. How will we recognize a gamma squeeze happening? How long can it take to play out? The timeline for a gamma squeeze can be longer than you think. It is driven by multiple factors, and the intensity of each of these factors adds pressure to the overall squeeze. It can be broken into a few parts. Share buying. As shares are bought causing a rise in the stock price, market makers must hedge by buying shares as delta rises. The faster the rise in stock price due to buying pressure, the faster delta increases and the more shares need to be purchased by market makers. This is due to the need to deliver these shares the following week as more calls become in the money. More on this below. Call buying. The more calls bought, the more shares must be purchased to delta hedge. If I purchase the $8 strike for August 20th expiration, that call has a delta right now of 0.6. This means the market maker will purchase 60 shares to hedge against this. In one respect, I think you can view buying calls as a way to effectively move the market as though you purchase that many shares for a fraction of the price. Hence the fact it is a leveraged bet. The current value of the call option is $59. However, it would cost you $492.60 to buy $60 shares to have the same effect. That said, please do not just YOLO call options. I'm doing a mix of calls and shares. Call options expiring in the money and their delivery. The more calls that expire in the money on Friday, the more this impacts the price of the stock the following week. If you weren't aware, options expiring in the money must have their shares delivered to the exerciser of the contract by T+2. If the call writer is short the stock, they must buy the stock on the market. As a result, we usually see a surge in stock price following options expiration if a large number of calls expire in the money. This surge in stock price causes a surge in delta, which further compounds the rise in price as market makers buy shares to hedge delta. It's this T+2 option delivery, combined with futures rollover dates, that I believe is going to help catalyze the next run. Closing short sales. As share price increases and borrowable shares dwindle, the borrow fee for short positions rises. Eventually, this becomes untenable for short sellers and they must purchase shares to close their positions. We've beaten the short squeeze scenario to death in this subreddit, so I won't go into more details. Just for data, the most recently reported August 10th short interest on Fintel shows 22.48% of the float is short, though Ordex estimates this has increased as of Friday, August 13th to 25.58%. Go figure. After that price action we saw on Friday, short sales have likely been used to suppress price prior to the massive buy-up necessary due to futures contracts. See below. Failures to deliver. CLOV shares that failed to deliver in the first 2 weeks of July is a staggering number. There were 46 million shares that failed to deliver, compared to the 22 million in June, versus the 6 million in May. These shares must be delivered. FTD data for the second half of July should be available on August 16th. 46 million shares out of the public float of 133.76 million equals 34.3% of the entire stock's float failed to deliver in the first 2 weeks of July. High number of shares that fail to deliver usually indicates high amounts of short selling. Additionally, after the 30th of June, it appears that skyrocketing FTDs is correlated to a consistently falling share price that sees no Tuesday recovery due to options delivery. You can see a spike each Tuesday in June due to this, followed by a drop in share value. For me, this was the last piece of the puzzle on figuring out what is going on with the meme stocks. The triple witching day is well known and happens when futures expiration meets quarterly option expirations, but the time frame for equity rollover was completely unknown to me. On September 9th, the next futures contract rollover date happens. There is evidence that much of the meme stock activity is due to someone on the bad end of a futures basket that included many of the meme stocks we love so much today. Each major run-up has been just before the futures rollover date on many more stocks than CLOV. Some of those companies show movies, others sell stuff to gamers. I don't want to name them and get flagged for removal. The last futures rollover date was June 10th, the week that was the peak of our last meme circus. CLOV's peak was seen on June 9th, and the futures rollover happened the following day. CLOV stock never recovered. We can see that the beginning of rollovers started on May 25th, the same day we started to see CLOV climb up from $7.01 a share. The following week it closed on Friday, June 4th at $9.12 a share. The next Monday, June 7th, it rips up to $11.92 by close, followed by a run to a close of $22.15 on Tuesday, the June 8th. Wednesday, June 9th saw a high of $28.85 and a close of $16.92, ending the squeeze. You may ask yourself why it took so long for it to run up like this. The objective is to cover at the very last minute and avoid retail traders piling on to make the problem worse. If retail traders were to push the value of the stock higher each week, allowing more calls to end in the money through the buying of shares and in the money and at the money call options, Then this run will end up moving sooner and moving higher. This is the exact scenario they want to avoid, and why you have never heard this information until now. What to look for in confirmation? Market maker algorithms generally move prices to max pain. This is where option riders are hurt the most and the least impact is placed on the market maker. When we end above the max pain level, which for August 20th is $9, it puts more calls in the money, which usually leads to increased price action the following week as shares are bought to deliver for options contracts. If it closes over $9 a share this Friday, that puts an additional 20,952 call options in the money. If we go over $10, this adds another 32,382 calls in the money. The more shares purchased this week by retail, plus the more at the money and in the money calls will put pressure on this gamma squeeze to get started. The higher the price ends this Friday, the higher this event goes. How to cause the most impact on the stock price. If you plan to participate, I suggest buying shares and in the money or at the money call options. One method of acquiring shares is buying a call option. If you buy a call option for August 20th, the $8 strike is $59. The current share price is $8.21. If you purchase the option and choose to exercise it, you can have the effect of the call's delta, forcing market makers to buy shares to hedge. Plus, when you exercise, you can acquire 100 shares and force a higher price on Tuesday during options delivery. My strategy involves deep in the money calls this week, which I will exercise on Friday. I have the $6 strike call, which will allow me to call away 100 shares for $6 each. I chose this as the shares did manage to reach $7.01 in May before the run, and I want to make sure I don't end up out the money. I also have the September 3rd call for the $10 strike and the September 10th call for the $11 strike. I do not plan to exercise these calls and instead sell them during a bullish run-up during their week of expiration. Good luck, have fun, and set yourself up to get out of this 9 to 5 bullshit. We deserve better. Let's see what some of the comments have to say, shall we? Let's go, it's time for another gamma. CLOV up by now. Ah yes, in proper Wall Street bets fashion. Buy high and sell low. Anyways, moving on. If you could arrange this by Friday, that would be great, thanks. My 37,500 shares that is currently down 300k is pleased to read this DD. Better than my 300 plus calls that already expired. Got another 200 expiring August 20th. Most are $11 calls, only around 50k, but I can't hold that and wait. Damn, I feel bad for that last guy. He had most of those 200 contracts expire worthless yesterday. If you enjoyed this video, be sure to like, comment, and subscribe, or else you will be forced to trade on Robinhood for the rest of your life.